Okie dokie. Ah, sweet. We are live. What a time to be alive. Oh, nice. Okay, perfect. We are up and going. And I want to make sure I can see the comments in case some people join and have some juicy questions. Perfect. Close that. Alrighty. We are live. So today's live stream, we are going to be building a model for Lemonade Insurance. We currently have a model already for Lemonade Insurance, and we updated that yesterday after the announcement that they are decreasing reinsurance for their enforced premiums from 55% down to 20%. But I just want to go through it again, make sure the math's correct, and I think it would be worth it having this more detailed model for Lemonade Insurance. I also want to play some clips that I think are really interesting about Lemonade. Go over their Q1 2025 shareholder letter, all of that. So should be an interesting stream. And I hope you guys enjoy. So, all right, let's get into it. I already started laying out the bare bones of our model here. So we're going to project out growth 20 years. We're going to have our IFP in this top line, revenue as a percentage of IFP. So these should converge within a couple of years as they stop that reinsurance. They're not allowed to calculate enforced premium that they reinsure as revenue. So revenue currently is quite a bit less than their enforced premiums. Then we'll talk about their loss ratios, what they take home. I need to find out what this metric's actually called, because take home is definitely not the right name for this metric. So we'll have to see what they call that. Then we'll go to gross margin. We definitely want to talk about OpEx, and we want to exclude growth spend, because this is an important metric. Then we probably want to have a separate line of growth spend, and then we'll go through the good old adjusted EBITDA and then net income. So that'll be after taxes and all that. Then we'll get a PE ratio, all that kind of stuff. So yeah, we can model out a PE. We should definitely have a market cap. So that will be good to have, and we should be able to, let me see exactly how we do this market cap in Sheets. Okay, here we go. Just copy it over. And we should be able to do that. Perfect. Yeah, Google Finance, New York Stock Exchange, Lemonade market cap. Perfect. And we want this to be a dollar amount. Format number. We want that as a currency. Perfect. Let's expand that a little bit. We probably don't need the cents, so we'll just do rounded. Give us a little bit. So yeah, market cap 3.283 billion. So quickly take a look at their stock price. So IPO'd back here in 2020, had a pretty decent run, followed by a little bit of a pullback, followed by a massive run, and the stock's all-time high. This was, in my opinion, definitely overpriced, and you can see from this huge pullback that the market thought so as well. So yeah, we are currently nowhere near all-time highs. These are a couple of my technical analysis. Now that we're down over here, we have a few supports. We have support around $24, $23. This one, I don't think we're ever going to go that low again, though I would love to have the opportunity to buy again here, but yeah, I don't think. And then we have a little bit of coming off of these low points, like coming up there. So once we get out here in terms of time, the support I think will start to raise, and then kind of a support from kind of these tops here, this bottom. There's a little bit of technical analysis. Technical analysis, I think, in my opinion, is mostly big nothing burger. But we had this beautiful shape, V-shaped recovery. So there's started getting some excitement about the stock. Obviously, Trump tariffs came in. We had a big pullback all the way down here in, I think that was April 11th. And then we have had a very, very nice recovery since then. But yeah, those are some technical analysis, not that important. What we want to know is our potential returns. So let's pop open the shareholder letter. So our in-force premium as of Q1 2025 is 1.008 billion. So go ahead and throw that in here. That's going to be a numeric or number. That's million, thousand, hundred. So that's our IFP. Let's just change. Well, we don't want this to be a number. Let's do this. We want this to be, these are all, well, they're not all going to be numbers actually. So we'll change this row into a dollar amount, number, currency rounded. Same for this. It's going to be currency rounded. So, yep, the joys of being a stock analyst. We're going to build spreadsheets today for today's live stream. But this is good. This is what you want. All right, so in-force premium. We're starting at here. Revenue was, let's go back to the shareholder letter. Revenue, here we go. I didn't pass it already, did I? know we're right at the top. So in-force premiums, IFP year-over-year growth rate accelerating. We love to see that. The loss ratio coming down. We're going to need those metrics here in a second. But what we want here is revenue. Okay, so this is their estimate for full year 2025, but we're going to look at trailing. Should be about 500 million. So key operation and financial metrics. We have customers, in-force premium, total revenue. Okay, so in millions, 3 months ended. So this is comparing year over year. We want trailing 12 months. So let's see. Do they give trailing 12 months revenue? You might have to look. We'll just go over here. I have a free trial for fiscal.ai. A bunch of YouTubers use it, so we'll see. Let's see, returns. I don't know how to use this platform super well yet, but it does have a lot of good information. Probably here in financials, total revenues. Perfect. Okay, so this is total revenues, annual millions. Okay, so 558. Perfect. So 558 million. And this whole row is going to be currency as well. Alrighty. And I'm pretty sure, well, we can calculate this. Let's open a calculator. So we want to know what percentage they have reinsured based off of this. I believe it's about 55%, but it looks like it's probably less than 55% based off of this IFP and this revenue number. Unless they increase reinsurance at some point, but I think we want 558 divided by this number here. Yeah, so 55%. So 55, they only have 45% reinsurance. So 558 million is 55% of 1 billion and 8 million. Okay, so revenue percentage of IFP is 55%. and they just dropped this number from what it was before to 20%. So it's going to be revenue as a percentage of IFP is going to go up to 80%. So what we're going to do is we're basically going to project out growth based off of their guidance for these years of IFP, and then we'll increase revenue by seeing what percentage of IFP they have reinsured. We'll have to kind of make a guesstimate of when they're going to drop this reinsurance completely. We originally weren't thinking that they're going to drop this reinsurance until maybe year 6, a couple more years out, and they were just going to keep growing reinsuring. So this is actually really bullish. This is even more bullish than we were being in terms of how soon they would start to drop this reinsurance. All right, and then I do remember this off the top of my head. They have a 73% loss ratio, and I think this is probably going to be way less. I think this number in Q1 is skewed by the fact that there was the fires in California. So this is trailing 12-month gross loss ratio. So I think the gross loss ratio for this quarter was probably by itself a bit higher than Q4 because it's trailing 12 months, so it's taking the average of the last 4 months. So yeah, it was probably somewhere below 79%, somewhere above 73%. But what that does mean, most likely, is that next quarter it's going to come down again, right? So this was artificially held higher by that special event in California that was and this will happen from time to time in Lemonade's history. They can't predict weather events, so there's just going to occasionally be something that they didn't predict that's going to increase their gross loss ratio for the quarter. But we're going to have to look at this as an average. And I could definitely see this coming down to 70% for sure. I mean, based on this trend, that was a pretty steady downtrend. Looking like it's losing between 3. So this is a 4% drop here, and then a 2% drop, and then a 4% drop again. So between 2 and 4%, they improve their gross loss ratio per quarter, which is pretty crazy. You project that forward, and not too many quarters from now, they're basically going to have a super low gross loss ratio. I really think the reason it flattened off here was because of those California wildfires. So, we could see as low as 70% next quarter, maybe, from 1 year from now, we could see it in the 60s somewhere, maybe low 60s. I think it will probably kind of stable off at some point, I would imagine, because eventually what they're going to start doing as their gross loss ratio gets to somewhere down there, they're probably going to start lowering their premium cost, which is ultimately going to increase revenue, because if they can offer even at a more competitive price, they're going to draw even more and more customers, and this could skyrocket revenue growth, in-force premium growth, a lot. So this is really bullish. I don't know what their ultimate goal is with this. I might come back and revise that a bit later. But yeah, we can project this out a little bit now probably. Let's do a little bit of gross loss ratio. I think in 1 year could probably see it come down to 70%. There might still be a little bit of well, this is trailing 12 months, so TTM. There might be a little bit of a hangover. Well, in 1 year, this quarter would have dropped off. So in 1 year, well, this is what I'm thinking in 1 quarter. So, I mean, in 1 year, we could see it as low as 65% actually. And I think probably once you hit 65%, let me ask Perplexity, has Lemonade stated what its loss ratio target is? Do a little bit of research with Perplexity here. 70 to 75%. Okay. So, yeah. the company's Q4 24 gross loss ratio was 63%, its lowest on record, and marked an improvement over previous years. That's crazy. Okay, so wow. Their gross loss ratio probably was massive in Q1 2025 because of those wildfires. But 63%, I mean, that shows how low it can go. I think they either start lowering prices or they get down to like 60%, maybe even lower. Because that's incredible. As they just get more and more data from their customers, they get better at writing policies. Like, that could go so low on a trailing 12-month basis. Yeah, they're already at 63%. I feel like this 65% is super, super likely. I think the only thing that can hold their gross loss ratio up higher is they start to bring down their price of the insurance. And if you start bringing down the price of insurance, I think their forecasts for IFP growth are way underestimations. Like, you start to become even more price competitive, like your revenue, your in-force premium just starts to explode. So yeah, that's crazy. So just making sure, you guys should feel free to ask any questions if you have them. I'm monitoring the chat, so I'll try to answer them. Okay, so the question is, do we think that the loss ratio is going to go down to 60%, or that they're going to start dropping prices? The fact that it was 63% in Q4 already makes me think that they might let it get as low as 60% and then start dropping prices. But their stated target is 70 to 75%, so they already should have been dropping prices. But if we're talking about a trailing 12-month basis, they haven't hit the trailing 12-month basis of 70% yet. So maybe that's why they're not lowering prices. So maybe once we get to a trailing 12-month loss ratio percentage of 70, that's when you start seeing the price dropping. Yeah, I would really like them to. I mean, right now with them growing so fast, I mean, they just have so many levers to pull. Like, they start to see growth decrease. They just like drop prices. Their gross loss ratio goes up a little bit. Or they start increasing like growth spend through their synthetic agent program. And like, they just have so many ways to just continue pushing growth. It's crazy. So, okay. What is management's guidance for IFP growth? I'm pretty sure it's 30%, but I think it could definitely be higher. IFP 28%, with the company projecting to reach approximately 1.2 billion in IFP by year end 2025. This guidance represents a sustained acceleration, with management reiterating they are progressing towards a cruising velocity of 30% IFP growth expected in 2026. I think they're sandbagging a little bit. I mean, they just can so easily like manipulate their growth with these synthetic agents. They have such good leverage over their growth. Can be pretty much exactly what they want it to be. So I think this could be easily 30%, and this could be above 30%, and this is like a cruising, so I think they can probably sustain this for quite a number of years too. So okay, let's see. Their loss ratio is 73% in their IFP. I don't know what this metric would be called, because I think revenue is calculated quite differently than because there's a cost of paying out these premiums. There's, you have to pay customer support agents, so that adds to your cost. So gross margin, gross profit, and this is not gross margin, this is gross profit. is different than like your take home from the IFP, enforced premium. I don't know if they track this metric. I mean, I don't even know what this metric would be called. I mean, we could calculate it real quick. It's just, you know, 73% of their IFP. So, but this is like assuming no reinsurance, so it's a little bit weird. I'll calculate it out, but in fact, I think we can just equals times 73%, and that should give us the number. Perfect. I love Sheets so much. It makes it so easy to calculate these things. Take home of IFP. I don't know what this, again, I don't know what that metric's called. So, all right, let's get some more metrics in here. This is the trailing 12-month gross loss ratio, IFP growth rate. So you see that accelerating towards 28%. We want now our gross profit, gross earned premium, enforced premium, gross earned premium. So all in millions. Revenue. I don't know if this is this looks like yearly, maybe full year. Not exactly what I'm looking for, I don't think. Here we go. Gross profit. Okay, total revenue. This is for Q1 2025. We have that 151 million. Gross earned premium. So I'm guessing because this is greater than the total revenue, quite a bit of this is due to reinsurance. Man, I need to get better at reading financial statements because I am not understanding this. Net loss. This shows a bit of my inexperience. I'm pretty new to this as well, so I'm in a learning phase. So forgive my ignorance on this. I think we might be able to get these numbers from here instead. Let's see. So the gross revenue, if they have it on here. Let's see. I'm going to go to, I know how to read this website. Okay, gross margin for Lemonade. Trailing 12 month. Okay, trailing 12 month gross profit. So, okay, 260 million, which would 260, and this is going to be a dollar amount as well. Perfect. So we can get a gross margin by, I think we want to say, oh no, why do you do that? Get out of here. These stupid suggestions. Gemini, get out of here. Divided by this. Okay, so gross margin percentage, 46%. Gross profit. So I don't know how they, like, what does this include? I'm a little bit unaware on this one. If anyone has any insight, please share. But this one I do understand. OpEx excluding growth spend, and I love Lemonade because they make this so easy to see. And this is also just insane. Like 89 million. I'm guessing this is for, yeah, this is just Q1 2025. So I'm going to annualize that. Okay, so growth, excluding spend, again, that's 89. All right, 89 times 4. So this is our operating expenditure, 356. 356. And then we gotta make this all dollars again. Okay. Gross spend. I don't know if they break out gross spend. The interesting thing about their growth spend is they have to count it as like a loss or part of their operating expense, even though they aren't the ones paying for it. So this is what they do with like the synthetic agents. The synthetic agents pay for the growth spend with like a certain interest rate on it, you could say. And then they take a percentage of the in-force premium until they make back the initial investment plus like pretty much like an APY on that. But Lemonade doesn't have to output any of that cash themselves. So it's pretty crazy. It's a good setup. And then they don't have like traditional insurance companies pay these insurance agents like a percentage of the premium for the entire life of the customer. Whereas like with Lemonade, these synthetic agents, which aren't actually people, it's just like a VC fund, I'm pretty sure, that they have a partnership with, or some kind of capital firm they have a partnership with. They just pay for the pretty much the normal advertisement, so like any normal ad. It's a really good deal, and they don't have to end up. So I don't know if we can get this. I'm gonna delete this row. I don't know if that's a breakout. So we're probably just gonna have to do OpEx including growth spend, and this will probably be just their normal operating. This is operating margin. I don't know if they have operating expenses. Here we go. So this is including their gross spend. Is this okay? This is for the year. Perfect. 769. Perfect. Make sure this is the right format. Perfect. Total operating expenses. So it's probably, yeah. So that's a lot of gross spend. I mean, it's not all gross spend, but a lot of this is gross spend. So this is what their actual operating expenses are, which are like completely flat now, which is crazy. You can see over the last couple of quarters, operating expense just almost completely flat. It's gone up 1% compounded annual growth rate, which is like so tiny. Yeah, no, that's pretty phenomenal. Just double checking, make sure I'm not missing any chats. Alrighty. Alright, so let's start calculating this out. We're going to pull up a compound interest calculator. I mean, if you're compounding this at 1%, I mean, it's almost negligible. But we'll do it. 356. 356. We're going out 20 years at a 1% interest rate. So, and this is assuming that they're going to keep growing their OpEx, which I have a feeling they won't. I think eventually you'll see this OpEx start to drop. Like Shy is already releasing blog posts about completely autonomous organizations. Like, I think there's a good chance that Lemonade might actually become the first completely autonomous organization. So I'm going to actually project out that this only continues to compound for maybe 5 more years, and then I'm going to go out on a limb and say it's actually going to start like decreasing. I think there's probably a good chance that you do actually start to see, you know, gross spend decrease. So, okay, or yeah, OpEx decrease, excluding gross spend. So, we got 356, 359, 363, 363, 366, 366, 370, and then year 5, 374. Okay, and we need to add those zeros. Yeah, and what we want here is kind of we want to know basically we'll do an OPEX percentage of revenue. And we'll use that as like kind of a way to get our adjusted EBITDA. So we're also gonna have to calculate in tax rate to get earnings, and then we can put a PE on that, and then we can get a market cap starting to go. So just breaking this down to the part. So I'm gonna actually start to assume that OPEX excluding growth starts to drop. See, I wish I could break this out more because I want to know their growth spend, what other operating expenses they have. Yeah, what's their OPEX been growing at? Let's see this. Okay, so this is their OPEX, which includes gross spend. Does this give me a year-over-year change, like a kind of a CAGR for their OPEX? 30, 75, 175, 215, 362. Let me just pull up a CAGR calculator. See what this has been growing at. So our starting value, this is each year, was 30. And we are at, we're gonna do 724 to kind of get this. 724, and this is 1, 2, 3, 4, 5, 6, 7 periods. We're gonna get a 57%. That's crazy. That's been growing a ton, actually. I'm sure this includes does not include a lot of OPEX because OPEX stopped growing in 2022. So 2022, maybe we should calculate it from 2022 forward because OPEX pretty much stopped growing here. So they maybe stopped hiring between these 2 points. Yeah, I'm going to do that. So our starting is 543 and our ending is 724. And this is 3 periods. So okay, that's a huge difference. So yeah, they had a massive increase in OPEX early on, including growth spend, but since 2022, I think their OPEX excluding growth spend basically flatlined, and so now we've had a kind of a continual growth. And if you back out the 1% that has been coming from OPEX excluding growth spend, OPEX excluding growth spend, OPEX including growth spend, or basically the operating costs excluding like the actual operations, payment of employees, that's like 9% growth. Okay. Perfect. So OPEX, let's see, including gross spend. I'm gonna add another row above, and then let's do OPEX excluding operations. Excluding operations. Okay, so OPEX excluding gross spend. And then let's do one below. This is OpEx excluding gross spend. Oh shit. And this is the CAGR. So we're gonna say this continues at 1%. 1% out till here. And then operating excluding gross spend. So now we want OpEx excluding operations. So this is going to be this minus this. Oh, no, that. Perfect. So this is how much they're spending. And then we want OpEx excluding operations. I did it again. CAGR. So this is including gross spend, probably like interest expenses. This is everything like that's not just like paying employees and that kind of stuff. So OpEx excluding CAGR. Yeah, so this is, the total is growing at 10%. So if you exclude the 1% from the actual operation costs, it's 9%, if I'm doing that right. Just quick maths in my head. Maybe that isn't correct, but I'm going to assume that. Just in case I'm wrong with how I'm doing that math, I'm going to keep it at 10% actually. So they're growing all other expenses at about 10%. So let's run a compound calculator on that. Do we just want to assume that this is going to keep growing like that, kind of linearly at 10%? I mean, it's been decelerating as well. Like if we look at this, like when we included the 2017 through 2024, it was like a 57% increase in operating expenses. But when we went from 2022 to 2024, it was the 10% growth. So there's definitely a deceleration. What's the CAGR between just, and am I doing it over too many periods? The starting value, year end. I think I am doing it over too many periods as well. Wait. Because this is year end, December. So this is 1 year, 2 years. So I think I actually need to do this over only 43 over 2 periods. Wait, if I do this over 2 periods, what does that mean for the CAGR? I might have calculated this all wrong. It makes it higher. That might be correct though. It might be growing operations excluding operation costs. I know, this is so convoluted. So yeah, because this is your starting value, December. So this is year end. And we're growing it over 2023. Yeah, so we're taking a starting value. Okay, so I need to put this up. I didn't calculate that wrong, right, the first time. So this is actually 15%. But it's decelerating. So if we take this, the last 2023 to 2024, operating expense 652 to 724, and this is just one period. What is that? 11%. So it is decreasing. So it decreased, well, it might have been decreased by more than that to 11% just this last. Okay, I'm going to do this at 11% because that was the increase from 2023 to 2024. And as all these numbers just get larger and larger, this is going to continue to be a smaller and smaller CAGR. So yeah, we're going to say 10%. We'll do that for another year. Drop this down to 9. We'll do 9 out till 5 years. And then we'll drop this down to 8%. And we'll bring that out another 5 years. This is a little bit of guesstimation. Like this is basically what is their, cost of growth gonna continue to grow at, and interest payments, any kind of other operating excluding like staff. I don't know if this also includes offices as well. But I'm gonna assume that this is gonna go flat for maybe a year or two. And then I think it's gonna actually start decreasing as they become more and more autonomous. Like, you're gonna be able to replace more and more rules. People are gonna drop off the payroll, and you're not gonna have to hire them back. And this is pretty conservative. Like, I think this could actually start happening way sooner than 2030, potentially. So, but I think it's gonna start getting a minus, like a negative growth out past here. So, okay. OpEx excluding operations CAGR. Perfect. So we can start to calculate this off based off of this. OpEx percentage of revenue. Yeah, so this is going to be calculated out. So this is going to be equals this plus this. So that's how that's going to be calculated out the rest of the way to 20 years. And that'll automatically be populated. Okay, so we can actually make a equals this. We're gonna have to add some brackets. Equals the sum of that plus again this times the percentage. So that's basically a CAGR. It's calculating off of that. How does this calculate? Perfect. These freaking so we could just put the percentages here and it should calculate out the rest of the way. Perfect. Alrighty. And then if we take this same formula, should be able to put it in here. Perfect. Okay. Now we're cooking. So there's no percentage there. So this should shrink from this year to this year. Yeah. Okay. So if we assume this goes out for a couple more years and then starts to accelerate, I mean, you can start to see 2%. Like maybe you can start seeing like 3% decreases in operations, excluding growth spend. I mean, you could start getting nutty where like more and more people. But we'll just assume like a kind of terminal where the operations continue to drop at like 5% out this way, which I don't think is crazy. Just like as you can automate more and more, like this could be way more and way sooner. You could start to see like a decrease in operations excluding growth spend. But yeah, we'll assume it starts year 13, kind of hits its terminal like decrease rate at 5%. So, you know, that's just like as people leave the company, we don't have to hire that person back. Because there's basically an LLM or a, you know, some kind of artificial intelligence that's able to do that. And I don't think that that's like unrealistic. They've already only been growing OpEx at 1%. So just assume that that starts to turn around as they just continue to automate more and more and like decrease that. I don't think that's that crazy. And I think that's actually probably pretty conservative. So, okay. So this is OpEx excluding operations. Yeah, okay, so we broke that out, and now we're calculating this by combining these two numbers together. So, all right, what do we want to think the terminal growth spend increases at? I mean, maybe we get down to 5% out here, and then we just keep increasing by 5% out to 20 years. This is basically our marketing budget. I mean, it's already been decreasing. That's why I think that's possible. That would be a massive increase. Alrighty. Yeah, so 1.763 billion operating expense in year 20. That's kind of what we're calculating out here. Gross profit, gross margin percentage. Okay, I don't know if we're going to forecast all of these out because I don't really know what advantage that takes. But what we do want to do is we want to add below, we want to add an IFP CAGR. I actually like this way of doing it. This is really nice. So IFP, what did IFP grow here? Q1 27%. 27%. And they're saying for year 2025 it's going to be 28%. I think they're being conservative, so I'm going to say it's going to be at least 29%, if not 30%. And then they're going to reach a cruising altitude of 30%. So, I mean, this could mean cruising for 4 years, 10 years. We'll put it out to year 5. So we're going to take this same formula we got here and throw it in there. Make sure that's great. Perfect. So sum equals last year's premium plus last year's premium times percentage growth. Combine those together and we got IFP in 1 year from now. And we'll see if that lines up with their estimation of IFP in 2026. I think they have a guidance here somewhere. I probably passed it already. I almost most definitely did. Okay, let's see. Let's see if we can do a little find function here. 2026. Alrighty. Sustained acceleration towards our cruising velocity of 30% expected in 2026. Okay. Full year. It's pretty much in line with what they're guiding, so I don't know, so I can find that exact number, but alrighty. Pretty sure anyone can chat, live chat. Okay. Just making sure. I see a couple of you guys have been watching for a while, so if you guys have any questions, you can throw them in the chat. If you have been and I have been missing them, I am not exactly sure what to do. Let us see. Yeah, I mean, I'm assuming I'm getting all the chat, so I'm on my personal YouTube account watching the stream, so and I have the chat open there, so okay. If you guys have anything, you don't have to say anything, but if you have any questions, you can throw them in there, and I'll try to answer them about Lemonade. All right, so now we need to take this, and we'll throw that out to 20 years. We obviously need to continue. So I think for being conservative, like we can probably throw 28% for the next 10. And then in our other model, we kind of assume a 15% after that, which might be a bit conservative. It depends how much leverage they still have on their growth ability later on. So, okay. Now, revenue percentage of IFP. So, it's currently 80%. They could keep it at 80% for the next year or two potentially. And then if they drop this one already, we're just going to be conservative and say they're going to keep some reinsurance, and then we're going to go to 100% here. They're going to drop IFP reinsurance in year 6. So this will literally equal that for the from here on out. But for this, this will equal this times the percentage that it is. So it's not quite, because they'll still have reinsurance. So perfect. Okay. Yeah, so there might be another huge jump at some point, like this huge jump here. That's going to be massive. Like that year over year growth in revenue is about to be insane. Just dropping this reinsurance from 45% to 20%. So revenue as a percentage of IFP going from 55% up to 80%. That's just an instant massive unlock in revenue. So yeah, that's pretty freaking insane. So loss ratio. Yeah. Okay. So let's see, loss ratio 65%. So this is going to be equals this times this. So this is going to be basically their gross profit. Gross profit margin. I mean, it's going to be slightly higher because there's associated, but I don't know if that's included. See, I'm going to delete these because I'm not exactly sure how they're calculated. And they are not helping me do this forecast. So we're going to delete that. Perfect. So this is going to be a calculation of that. We can pull this formula out to year 20, which means we just have to estimate our gross loss ratio. If it actually is 65%, I mean, this is crazy. And like, that's not a crazy number. Like, their gross loss ratio is already 63% in Q4. So, I mean, I might be a little high here with the gross loss ratio, honestly. But I kind of just want to pull this out because their targeted gross loss ratio is 70 to 75%. So this might be too bullish, actually. They might start to lower price, which if they lower price, I mean, you could see this IFP CAGR grow, and be even higher than what it is here. I mean, 30%, you start to see them undercutting prices. You know, we take this down to 70% maybe, and we just stay at 70%, and they keep dropping prices and they keep dropping prices. Like, you could see this revenue growth percentage just explode. You know, you start to undercut Geico, you start to undercut you know, Progressive and Farmers. Like, you could see this IFP CAGR go way above 30%. Like, everybody's gonna be hyping, like, jumping on into Lemonade Insurance if they actually. So I mean, one of two things is gonna happen. They're gonna either keep their loss ratio at 70%, which I think is like not ridiculous at all, considering we already saw, you know, Q4 last year have a 63% loss ratio. So that's one quarter. Then we have the trailing 12-month loss ratio at 73%. Again, this Q1 2025 loss ratio is a bit skewed by the California wildfires. So 10%. The Q4 2024 loss ratio was 10% lower than the trailing 12-month. So, wow, yeah, they're improving their loss ratio quickly, which could either be reflected in their loss ratio continuing to drop even further, or it's going to be reflected in their price dropping like crazy. So, because they guided that they want to target 70 to 75%, I'm going to assume that they're going to drop the price, which a drop in price is just going to mean your revenue is going to grow even faster. So, I feel like I have to reflect it in their growth rate somehow. I'll be conservative. I'll say that they're going to beat this by a little bit, 31%, and then we'll say maybe 39% for a few more quarters, just because that the gross loss ratio makes them be able to drop that price, which it would increase their growth. Like they just have such a lower cost of goods. Like, They can offer the same insurance for so much cheaper. They can underwrite their prices so much better. So they can just take all of the best people to their insurance. So the way Daniel Schreiber, the CEO, says it is that 2/3 of people are better than average in insurance. Because traditional insurance is so bad at underwriting policies based on the actual risk of the people, they price all of the policies much more expensive, right? Because 1/3 of people are really dangerous, especially in car insurance. Like the example I think he was giving specifically was for car insurance. So the 1/3 of people that are far more dangerous than the 2/3 of people bring up the average price to that difference. So that's how you get 2/3 of people. You bring up the average. 2/3 of people are safer than the average. So they're paying well above what they should be paying for insurance. I don't know if this explanation is making sense. I hope it is. So if they could take those 2/3 of people that are overpaying because of the 1/3 that's far more dangerous and like actually price them appropriately and keep like a good loss ratio like they already are achieving. So like their loss ratio being 63% already shows that they're taking the safest people, you know. They know how to find people who pose low risk and write policies for them specifically. So that's reflected in their loss ratio just plummeting, which means they can price even better and they can continue to climb up the ladder of like riskiness, and just slowly take away business from these big insurers, which the big insurers, they're going to be left with the worst risk people. So their policies are actually going to start getting more expensive, right? Because all of the really safe people, the 2/3 of people that are paying more than what they should actually be paying, they're all going to leave to eliminate insurance. And the 1/3 that's more dangerous, now the traditional insurer is only going to be insuring them. And then they're going to have to price for just those people, and their average is not going to be being brought down by the safer people. So their prices are going to start to increase, and then as that price starts to increase up the levels of risk that the person poses, those people will be like, oh, it's cheaper for me to go to Lemonade because their risk is appropriately, like it'll just keep moving up. I hope I'm explaining it in a way that makes sense, but I mean, you're basically you have a path to take the whole market just by pricing people more effectively, and by being able to offer insurance with lower operating expenses because you're automating so many things with AI. So yeah, it's just super bullish for this company. It's going to be crazy. So all right, OpEx as a percentage of revenue. So this is going to equal operating expenses divided by revenue. So obviously it's going to be, oh, could it not go negative? Is that the problem? I think it's doing this because it can't go negative. So once we go out here, it should give us no, something's wrong. Oh, I need to change this to a percentage, not, okay, that's what's wrong. Number, we want a percentage. Perfect, here we go. Yeah, see, this is crazy. You start to say, okay, how much is the operating expense as a percentage of revenue? So like obviously they're not profitable right now. They pay far more in expenses than they get in revenue, but you could start to see that number drop super fast. So yeah, that's crazy. So they obviously spend a lot more than they make in revenue. So that's why the company's losing money. But eventually, this is just how operationally efficient this company is. Like, OpEx and growth spend can eventually become such a tiny percentage of revenue. So, I mean, maybe that's a little bit. Growth spend might actually need to grow a bit faster, especially as you just get larger. In order to sustain that growth, you just have to advertise more and more potentially. So what I might do is just say terminal growth rate for operating expenses excluding operations. So it's basically your growth spend just like kind of continues to grow at 10%. I won't change that yet, but I might come back and change that. So, okay. Yeah, typically, like Geico, just for reference, Geico's like operational expenses as a percentage of revenue is like 15-20%. So if Lemonade can get their operation expense as like a percentage of revenue to 3%, that would be crazy. I mean, think about all of the parts you're eliminating. You're eliminating all of the customer support staff that are constantly there. You're excluding all of the insurance agents that are selling insurance and taking like a percentage of the revenue for life. You're eliminating all of the claims adjusters. Yeah, I mean, I definitely think that this is possible. It might be a little bit too low just because I'm underestimating how fast growth spend will have to continue to grow. But all right. Earnings before interest, tax, depreciation, and amortization. Okay. How do I want to calculate this? So obviously it's going to be negative. I mean, it's basically just OPEX minus revenue minus OPEX. Okay, right? So revenue, oh, no, revenue. Oh, no. Okay, wait. How am I calculating this? Revenue, gross profit. I'm doing something wrong here, I think. Times 70%. Oh yeah, this is definitely wrong. Okay, here we go. We gotta fix this. All right, so loss ratio. So this should really be okay. So this needs to be, assuming that everything that's not revenue is reinsured by someone else, so it's someone else's risk. It's going to be revenue times loss ratio. So this is how much they lose. Minus revenue. And that should get us the number. Okay, I probably need to flip this the other way, so we don't have a negative number. Oh, not C10. Perfect. Okay. So this is how much revenue they're taking in. This is how much they're losing of the premiums. And then this is how much they have left over to pay for operating expenses. Okay, perfect. Yeah, that's correct. So this is calculating wrong. Perfect. And then operating expense as a percentage of revenue. 70%. Okay. So to get adjusted EBITDA now, it's obviously going to be negative this first quarter. We basically need to, their loss ratio plus, and we can see if this is right. So it's going to equal this percentage. I mean, can you plus percentages together? What do I see? We need to calculate this different. We need to get adjusted EBITDA. Oh, I always do that. Margin percentage. Okay, and this should be pretty much the remainder. So everything you don't lose, all the premium you don't lose, plus all of the stuff you don't spend on OpEx will be your earnings before, you know, taxes, depreciation, all that jazz. MicroStrategy. That's the Bitcoin treasury company, right? Yeah, Lemonade's a really good company. I don't know much about MicroStrategy, Jacobs. Do you follow Beat the Denominator? Beat the Denominator is a great YouTube channel, and he talks about MicroStrategy a lot. But I think Lemonade is also a really good company. I can't make that decision for you. Obviously, it's not financial advice. So, but yeah, fair enough. Hoping to sell some MicroStrategy, buy some Lemonade. Definitely, I can't tell you whether or not selling MicroStrategy into Lemonade is a great idea, but starting a position in Lemonade in terms of, you know, my educational, non-financial advice is a good idea. All right, so adjusted EBITDA margin percentage. Okay, can we just plus these two percentages together? I don't know if you can do that. Basically, yeah. Well, we need to like reverse this somehow. Shit. I don't know how to do this. I'm gonna have to figure this out. Of course, but okay, so you can plus the percentages together. So OpEx adjusted EBITDA, but we want this in the negative. Frick. My brain's blanking here. Do a minus 100. No, definitely not that. I don't know why I thought that was gonna work. EBITDA margin. It's basically the remainder. So if operating expenses as a percentage of revenue, so operating expenses 70% of revenue, and they lose 70% of revenue in payouts. So this isn't really their EBITDA margin. This is like what percentage of revenue isn't kept. So it's saying it's not going to, this is something wrong in my calculation because they are guiding to be EBITDA profitable by 2027. We'll confirm that over with Perplexity. When is Lemonade guiding for EBITDA profitability? Still didn't quite get it right. Pretty sure the guidance is 2027. Lemonade Management is guiding for positive adjusted EBITDA prior to year-end 2026. This target is consistently reiterated in recent earning reports and shareholder letters, with management describing EBITDA profitability in 2026 as their North Star for 2024. Lemonade's guidance remains for a negative adjusted EBITDA in the range of 135 million to 140 million, but the company expects to reach break-even and turn positive on adjusted EBITDA basis before the end of 2026. So something's definitely wrong in my modeling. OpEx is, maybe this is being calculated. No, that's definitely right. OpEx including gross spend. Is this number wrong? Total operating expenses. Total operating expenses, annual and millions. Damn. Operating expenses, loss ratio, IFP. I mean, it should figure itself out. Pretty close. I'm trying to figure out what I'm doing wrong here. I mean, this is definitely not right. I can delete that. Yeah, maybe I could just do adjusted EBITDA. So it's basically what they take home. That's true. Minus their operating expenses, including gross spend. But yeah, this says they're going to be losing money for a lot longer than the company is guiding for, which makes me think I'm definitely calculating something wrong. In the short term, at least. Yeah, maybe something here. I'm pretty sure it's all trailing 12 months here. Revenue is trailing 12 months. IFP is trailing 12 months. I'm guessing this, something I'm calculating here is incorrect. If anyone knows what I'm doing wrong in the chat, please let me know. OpEx excluding operations, OpEx excluding gross spend, OpEx. So this is just all OpEx. Maybe that's a better name. And that is this number here. $769 million. I mean, according to this, they don't get profitable until 2031. Oh, that's not what I wanted. All right, I might have to fix this off stream, but I'm gonna keep going, just so we can actually get like some price targets. So, tax rate. What is a typical tax rate for an insurance company? What does a company typically pay as an effective tax rate? Probably should have specifically said the U.S. corporation pays an effective tax rate of around 21% on its earnings before taxes, as this is the current federal corporate tax rate. The effective tax rate is calculated by dividing the total tax paid by the company's pre-tax earning and represents the average rate actually paid after accounting for deductions, credits, and other adjustments. Yeah, I know it's usually less. For many large corporations, the effective tax rate often ranges from 15 to 25% in practice, though this can vary significantly by industry. Yeah, so you're going to have write-offs. We're just going to assume this is the federal tax rate, 21%. I've never modeled out tax rates before, so this is a new one for me, but hopefully it's, so it's going to equal adjusted EBITDA times this. We're going to put this in brackets. So it's going to give us, and then we actually want this minus that. So it is adjusted EBITDA. Obviously that's not working correctly because it's a negative money, but it should start, yeah, okay, there we go. It goes correct here. So this is their net income. So net income after taxes. We can throw a PE ratio on that, and then we can get a market cap. Perfect. So obviously PE ratio doesn't really matter for these years where we are not profitable. Okay. What is a typical PE ratio for an insurance company and a company that just gets profitable? Okay, so property and casualty, life insurance, industry overall, broader averages 10 to 18 PE. We're gonna go on the higher end because, again, like Lemonade's gonna have way lower operating expenses, so it might be even higher, but we're gonna put this as our year 20 is going to be the industry average PE, so 18. But when a company first gets profitable, that's also a company who just becomes profitable, the PE ratio is often much higher than industry average. It's not uncommon to see PE ratios 30, 40, or even higher for newly profitable companies, especially if investors expect rapid future growth. I'm going to say it's going to start at 50 and then it's going to decline from there. So 50, 45, 40, maybe another year, 40, 35, 30, 30 again, 25, 25, 25, 20, 20, 20, and then we're at 18. It's pretty typical to see a company with a higher PE than its forward revenue growth. So, and if it's actually still growing at 15%, it'll probably be a bit higher PE. So this is probably a conservative metric, but yeah, basically this is going to be earnings times the earnings multiple, which is our PE ratio. Obviously, that is nada until we are profitable. All right. I mean, so this end calculation I don't think is too far off of what we were thinking. I don't know exactly what is happening here in the beginning, these first 5 years, because this is definitely not correct. I think this company is going to be, well, I mean, if it's going to be adjusted EBITDA profitable by the end of year 2, which is 2026. Well, technically it'd be Q1 2027, but so I'm definitely calculating something wrong here. I'm gonna do this, fix this off stream, but I think the more important thing is I do think these lighter numbers are correct. So that's a market cap. I'm gonna expand this out a little bit so it's a bit, and we're gonna close, we'll just pull these over here. That's not what we want. Throw these on here, make that full screen. And let's expand this so it's a little bit easier to see. Okay, so we got to keep in mind the current market cap. So current market cap for Lemonade, where we got it? It's somewhere on here. Market cap 3.22 billion. So I think I have it on my spreadsheet. I don't know why it just went over here. 3 point, it's right here. Oops. All right, so we have a current market cap of 3.2 billion. In year 6, we're saying that's going to be 16.151 billion. So we can get a ROI. So how many times greater is this? We just got to do this the right way. Is this divided by that? 4x. I think that's right, but this needs to be here. Oh, no. Okay. This divided by that. Yeah, there we go. obviously this way our ROI won't calculate because it won't be able to. But this way, it's also not going to be right because we are consistently referencing the wrong one. This needs to reference B. So that's not going to work. Okay, wait. No, I think I can do this. You just got to know the tricks. The tricks of the trade. Now if we grab both of these and pull it out, it should work. Nope, it's still referencing over. Okay, so we're going to have to manually fix every single one of these. This is annoying. There's got to be some better way to do this, but I do not know it. So here we are manually updating every single one of these. So this is basically calculating how many times larger is the market cap in that year than the current market cap. So, and this obviously is updating with real-time stock prices. So basically this is saying that if my estimations for IFP, revenue as a percentage of IFP, the loss ratio, what Lemonade actually takes home, their operation expenses, their like marketing expenses are all correct, their tax rate. This is the potential like X multiple, ROI X. So how many times, like every dollar you put in, like it will multiply into this many. So like 1 times 5. So if you make a $1 investment in Lemonade today, it might be worth $5 in 6 years, is basically what this is saying. I'm definitely making some kind of mistake in my calculation with these earlier years because I don't think that net income and adjusted EBITDA should be positive by year 2. And that's what the company is guiding for. So I don't know what I'm calculating wrong here. I'm going to have to fix that off stream and figure that out and let you guys know. But these numbers look accurate to what our other sheet are saying in terms of ROI percentage. So let me go compare this to this. So our other sheet is saying Lemonade is a 72x in 20 years. So this is 63x. So there's a slight difference, but pretty dang close. 10-year, we're saying an 18x. And this is saying 23x, so pretty dang close. So I'm pretty confident in the numbers past year 6. I don't know what's happening with years 1 through 5, because obviously I don't think they're going to be adjusted EBITDA negative in year 3 for sure. And by year 2, they should be adjusted EBITDA positive. So I don't know exactly what's happening with that. And adjusted EBITDA should definitely not be worse than net income. So, well, that's just because it's multiplying off of this tax rate. Weird. It's just, yeah. Anyways, there you go. That's how you build a model. So that's my model for Lemonade Insurance. Again, don't know what's happening here, but This is pretty accurate with what I think is going to happen. Obviously, not financial advice. This is just for educational purposes. But this is pretty accurate to what I think is going to happen with Lemonade. So this ROI right here. So multiples. So every dollar, $63 in 20 years. Keep in mind that the typical S&P 500 doubles about every 7 years. So you put in $1, 7 years, it's $2, 14 years, it's $4, 21 years, it's $8. So the type of ROI X that you're trying to beat is 8. So if you can do better than 8, you're going to beat the market. And we're saying we're going to 63X here. So we can throw that into a CAGR and see what that compounding is. This is over 20. So we're saying this can compound it potentially 23% annualized. So not bad. That's much better than the S&P 500. So I personally have a pretty big position in this company. Again, this is not financial advice, but yeah, very interesting. I hope you guys got a lot out of how I modeled this, learned a lot from that. Again, I am learning, so there's a couple things in here I removed. I know something is funky with these numbers here because that's definitely not accurate according to what management is guiding, but and some of this ROI multiples out here could be conservative. Like this is the trading range for, you know, legacy insurance, which is super high operating costs. You could see a company like Lemonade trade at a much higher premium because it's AI, all that kind of stuff. So, I mean, you bump this multiple up from 18 to 20, and then boom, like you go from a 62 to a 70. Maybe it's trading at a 30 PE ratio in 20 years. So, like, that's crazy. I mean, you go from 60 to 100x in 20 years. Now you're talking about a 25% annual growth rate, and every dollar you put in being $100 in, you know, 20 years. So you can mess around. This is why having a model is so good. You can mess around with all of these things. You can change your assumptions. You can, you know, copy this. Like maybe this is my base case. I want to copy this and I want to throw it down here. And so we could say this is Lemonade base case. We could say this is Lemonade bear case. And we can throw it again one more time. And we can say this is a Lemonade bull case. And we could just go crazy with it. You know, like maybe with the bull case. we do want to say this is 30. And maybe it's 30 and from all the way out here, you know, and like, I want to add a few more rows. This is too hard to see. Here we go. Okay, make it a little bit easier to see here. Missing an L. But yeah, maybe we say this is 30% growth. This is 32% growth. And this 32% growth goes out a lot further. And then we even get another year of 30% growth. And then a few more years of this growth. And, you know, maybe it doesn't drop down to 15% here, but more like 18. Oh, not 80. That'd be crazy. 18%, which is a pretty drastic drop, and that goes for a few more years, and like you can start already seeing this number's getting nutty. Okay, let's see, OpEx CAGR. Maybe, you know, we're even more bullish on this becoming a autonomous organization, so we're gonna say it already goes to a negative percentage here. We're gonna keep this, so it needs to be percentages. Format, number, percentage. There we go. So this already goes down to 0, and then maybe we pull forward this negative growth in operating expenses. We pull this forward. We pull this 5%. We can start seeing that decrease a lot faster. And then maybe here, you know, we could even jump up to like 8% negative operation. Like we're not paying hardly anybody to work at this. Like we're dropping off operation expenses for this company to AI left and right, and you can see that. Maybe growth spend. Yeah, we'll leave that the same. I think I was already kind of conservative on growth spend for my base case. I mean, so yeah, I mean, you do that kind of stuff. Operation expenses going negative even more. Like, you know, even more bullish on the IFP growth percentage rate. Like, well, we can even drop, let's drop this down to 65% as well. I mean, this starts to get stupid. Like 146. I mean, this is crazy. Like, if it actually 146x, and you make like an investment, let's say $10,000 times 146. I mean, that's pretty good. That's pretty damn good. I mean, this is obviously a very bullish case. Like, you're talking about eventually this company dropping operation expenses by 8% a year whilst continuing to grow in-force premiums at 15% a year. I think it's definitely in the realm of possibilities, like, for sure. But this definitely be a bull case. Whereas I think this would probably be my more realistic likelihood scenario with a 63%, so base case. And then maybe you go to bear case where, you know, operation expenses continues to grow at 1%, maybe this continues to grow at 10%. Gross spend, CAGR, they don't reach this 30% at all. They go 30% for a couple of years. Maybe this is their cruising, and then they drop down to 28% quite a bit earlier. And then, you know, this could be start dropping quite fast. 3, then you get to 15%. And then maybe even a couple years after that, this drops again, 12%. And maybe that's more of our terminal growth rate out here. And maybe we'll even put a little bit more conservative PE ratio. So, I mean, again, this is literally my bear case. And remember, to beat the S&P 500, we need to be an 8x. So even in this kind of like most pessimistic case, we're talking about a 35x, which is really, really good. So, especially when you compare it to the S&P 500's 8x. So, all right. I'm not seeing any more comments or questions. So, Jacobs, thanks for joining. I don't know if you're still in here or not. I hope you guys enjoyed. Look at this mess of a spreadsheet. I hope you guys got a lot out of this live stream. Again, not financial advice, just education. Hopefully you guys were educated on how maybe building a model might look, how to do some research. Perplexity is a great tool. It's for free. We're not sponsored by any of these companies. I'm currently just using a free trial with fiscal.ai. I don't know, maybe I'll buy a subscription to that, but I think you can get most of this information from like macro trends, and it doesn't require a subscription at all. So yeah, I hope you guys were educated on how we might run something like this. There's lots of tools like CAGR calculators, love macro trends, compound interest calculators. We love using things like this. Definitely encourage you guys to go run that. So I mean, what did we say, 25% potential growth rate in our base case. If you guys are able to average, you know, 25%, and you're in your 20s now, so we're talking about retiring, and you guys can invest $1,000 and add $500 a month or something. I mean, this is life-changing money, dude. Like, investing is absolutely insane. 188 million. So, but I hope you guys enjoyed. This is what this channel is about, you know, hopefully helping you guys learn how to invest better, talk about opportunities that we're seeing in the market. Again, not financial advice, but I hope you guys enjoyed this live stream of me building out this Lemonade model. And I'll probably do a couple more live streams this week, deep diving some other companies. So I hope you guys enjoyed, and I will see you guys next time. And make sure to like